morning, everybody. Thank you for joining us for this special edition of Candid Coffee. I'm Danny Ratliff here with Richard Rosso and Lance Roberts. So today we're going to be answering lots of different questions. We have quite a bit of information that's come in as far as Q&A. Obviously, a lot of volatility going on in the markets. Wanted to address all these for you. If you do have any questions as we're going through this webinar, please don't hesitate to go to the Q&A section. Also, if we don't get to something, go to realinvestmentadvice.com. Go to ask a question. Always happy to answer any questions that you guys may have. So what's on everybody's mind? It's obviously volatility. We kind of expect this to start the year, Lance. Obviously, quite a little bit more than probably most people anticipated, or maybe it just feels a lot worse than usual because last year we didn't have a whole lot of that. What are the Fed's actions and what do we expect here kind of moving forward?
Well, I think first of all, let's take a step back, and because you made an important point here, which is, look, the markets are down this year. Absolutely. Right. We're down about, 7.5% on the S&P. We're down probably, after Friday's rally, I haven't checked the actual, decline numbers for the year, but we're probably down about 8% or so, 9% on the NASDAQ. And that feels terrible. Right. But it feels terrible because we've had such a low volatility year for so long. Our maximum drawdown in 2021 was only 5%. So, and I've said this repeatedly on our show multiple times, and in 3 minutes of Markets and Money and things, is saying that, when we get a drawdown, a real drawdown in the markets of 10%, it's going to feel terrible because you just haven't been through one in so long that when it happens, it's going to feel a lot worse than it actually is. And this is what's been happening. And this is where investors start to make mistakes by getting extremely, kind of on one side of the ledger in terms of views. They start making, trading mistakes here. So this is where we have to be really, really cautious and come back to that investment discipline of really focusing on where your stop loss levels are, where your support levels are, and, quality of your stocks that you own in your portfolios, et cetera. You've got to really come back, set those emotions aside, and start to really focus on the portfolio structure itself. It's hard. It's really hard. So for everybody, professionals and individuals alike.
Well, and we get it because this is your hard-earned cash. It's your security, obviously, longevity, right? So that's why we think it's so important to do a financial plan. It's something you can always come back to. Rich, maybe go into a little bit about why that's so important when we get this market volatility.
You mean as far as what, keeping your head without losing it?
Keeping your head, but also understanding, what you prepared yourself for by doing that plan, by understanding the overall bigger economic impact.
Listen, when you do a financial plan, and I know it sounds boring, and it is, and it's supposed to be, because who wants all the excitement of volatility? What you're trying to figure out is stress testing worst case scenarios, like what we do at our shop. We have tried to prepare people for lower expected returns going forward. Lance and I worked on asset class returns because of where valuations, and Lance always says eventually math matters. But what you need to figure out is what return, your personal return, do you need to hit the goals you have, and focus on that. And I think that's what the plan does, Danny. I think it helps you run through the simulations of understanding you're going to get turbulent years, and volatility is not necessarily a bad thing. It's just par for the course, right? What do we say? It's the price of admittance. We put that into the plan. We stress test it. And sometimes going back to your plan at times like this is almost like having sort of an emotional blanket or a snuggie to say, hey, I'm still okay because this was built into my plan. And it gets you, you get to focus on the bigger picture as opposed to the day-to-day stuff of markets and Feds and other things.
Correct. And so, Lance, speaking about that, we're more active than most. We look at, try to mitigate risk along the way, took some exposure off earlier in the year. And then, looking at for some additional opportunities. Talk a little bit about, what's going on with the Fed. We knew the Fed was going to hike this year, but what changed in the December minutes and then also with what they just said this week?
Yeah. So much more detailed. I've got a pretty detailed explanation of all this in this weekend's newsletter. So if you go by the website right now, it's actually already posted. Just go to realinvestmentadvice.com, click on the newsletter link at the top, and I actually talk, about the Fed's comments about sooner than faster. One thing, real quick, I want just to tag on to what Rich just said a second ago. So it's really important here is that a lot of people are concerned about what's happening in the markets. Hey, I get it. Markets are down. I got a text from a good friend of mine that lives in Florida yesterday, and he really puts this into a good perspective if you think about this, because he's like, yeah, I'm really upset about this decline in the market right now. I'm only up 17% from last year now. And I think that's really an important point here, is that, we had such a big return year last year that, yes, markets are pulling back and they are coming back here. But, when you look at how much return you made last year, you're still, if your average, to Rich's point about financial planning. So if your financial plan says you need 5% a year, right? You've still got 3 years worth of gains locked into your portfolio already, even after this decline. So, perspective, unfortunately, what we do as investors, and this is really kind of the fault of the media, is that for some reason we decided we're going to look at markets from January to December, and that's our whole world. And, we forget about what happened last year because that's over. And so now we're down this year, and oh my gosh, I get emails, I'm losing all kinds of money. No, you're not losing money. The markets are just pulling back and prices are coming down, but you have to keep this into context of overall returns over a period of time. Volatility is going to happen. I was doing a recent interview with Adam Taggart, and we talked about how last year's word was inflation. This year's word is volatility. And we're going to have a lot more of this year. So, and now to your question specifically about, and this is why we'll have volatility. The Fed mentioned something very important on Wednesday, which is they're going to be tapering faster and sooner than what they previously had announced. And that was really what shook the markets up on Wednesday. We were up about 3.5% on the NASDAQ on Wednesday, completely reversed that entire advance into a negative territory right after that statement. And this is crucially important. People right now, and I'm getting a lot of emails from people. I got one just here recently, taking an entire portfolio, and they are in gold, silver, energy, commodities, all betting on this massive, tips, this massive inflation run we're going to have, because there's a lot of, individuals out there, granted, very smart individuals, that are talking about how this inflation run is going to be like we were in the 70s. And this is going to, just completely wipe out markets. Markets going to be down 50%. You need to be all on this commodity side of the trade. You got to be really careful. One, betting your entire portfolio on one particular outcome, because if you're wrong, it's really going to hurt you. And I'm not saying that thesis is wrong, but what we do have to come back and look at is what's really happening in the economy. Why? And so let's start real quick with why we have inflation, right? So we've got this big 7% inflation print that's going on. Markets and got everybody freaked out right now about inflation. Weimar Germany right around the corner. First of all, we have inflation because we injected $5 trillion worth of liquidity into the markets. And we didn't just, put it into infrastructure programs of jobs to nowhere, right? We sent checks to households, which gave people money to spend. And so they went out to spend it. Of course they are, right? People don't save money. Rich will tell you the average person in America can't come up with $500 for an emergency, right? So you give them money, they're going to spend it. That's great. The problem was you shut down the economy, so nobody could produce anything. So now we've got this demand surge and no supply. So what's going to happen with prices? They're going to go up. And that's why you have inflation. Yes, we've got rising wages, but where are your wages mostly rising? They're mostly rising in your lowest wage earner class right now, which are your restaurant workers, leisures, healthcare, services, Uber drivers, those type of things. That's where you're seeing wage increases. But you're not seeing it if you actually look at and break down wage growth between the bottom 80% of workers and the top 20% of workers, which are your supervisory workers. They're not getting wage increases. In fact, their wages are flat. So all those wage increases are occurring at the bottom end of the ladder. Now that's good news from the standpoint that they spend everything they make. But it's also a function that those wage increases aren't even keeping up with the current rate of inflation. So why is all that important? It's important for a couple of reasons. One, if you take a look at retailer inventories right now, huge surge in retailer inventories. If you take a look at a lot of the ISM manufacturing reports, you're seeing inventory concerns are falling pretty sharply. Inventories are building up. And at the same time those inventories are building up, demand is going to fall because all that liquidity we inject into the markets are now gone. Danny, you and I talked recently about the fact that the child tax credit, the last of the vestiges of the previous support bills, are now gone. There doesn't seem to be any hope on the horizon of more bills getting passed. And the infrastructure bill that was passed recently, that's dead money. Most of that is not going into infrastructure of any consequence. Out of the entire $1.2 trillion worth of infrastructure spending, only about 10% of that actually goes to infrastructure projects. And those are very small impacts to the overall economy. So the point here is that all of that inflationary push is about to reverse as we go further into this year. And lay on top of this now, the Fed is going to start hiking rates sooner and faster than expected, and they're going to tighten their balance sheet, reducing monetary impulse into the economy and into the markets. So the word for this year is going to be volatility from the markets and disinflation as we get further into the year. So, again, if you're banking your entire portfolio on this inflationary idea, you could very well wind up on the wrong side of this trade as we get into more disinflationary pressures moving later into this year. So this is why, kind of understanding economic dynamics of how money works within the economy versus how it's going to reflect in your portfolio is something where we're going to see a year where we want to definitely have some money allocated to value stocks, because those are good quality fundamental companies that pay strong dividends. They're going to stay. And they're not going to make a lot of money for you potentially, but they're going to shelter you if we do get a bigger drawdown in the markets. And you're going to see money shift back towards stocks that have the ability to grow earnings and revenue in a deflationary environment.
So really good point. So Lance, let's bring that back home to the average investor, in portfolio management. How do you manage the volatility in an environment like this? I know, you took profits earlier this year, reduced exposure some, and then looking for opportunities along the way. But this type of volatility isn't necessarily out of the norm. It's something that we have seen on average in the past. I mean, we looked at charts previously, looking at intra-year declines. We were lulled away by that by last year, which we were concerned with, because just a little bit of volatility feels terrible. Now, granted, we've had quite a bit more than a little, I think, at this point. What are expectations moving forward? You talked about not making any knee-jerk reactions earlier and how it's difficult trading in this environment. What should people do other than have a discipline and stick to it?
Well, look, I mean, and again, I kind of go through this a lot in this weekend's newsletter as well. We're going to get a reflexive rally here, and it probably started on Friday. Markets were really holding on to those October lows. And so right now, those look like those are going to stick. And so from a technical basis now, this is where investors are going to make one of two mistakes. One, they're going to assume that was the bottom. And that was a question I got from Charles Payne on Friday on Fox Business. Was that the bottom? Doubtful. But you're going to see a lot of people think that was the bottom, and they'll go chasing all the stocks that used to work and have been beaten down a lot. So you're already starting to see that. You saw a lot of the kind of the beaten down ARC type stocks have big rallies on Friday. So you're going to see that initial chase. The second thing that people will assume is that the market is just going to have a one-day bounce and then go dramatically lower. And it could. And all these are possibilities, right? It's all about possibilities versus probabilities. If we look back in history and look at how markets work from these deep oversold conditions, there is a real potential here for a rally that could be 3, 4, 5%, get us back up towards the 50-day moving average on the S&P. This is why on Friday we actually it seems backwards, but I have no idea where this rally goes. It could be a one-day rally and next week we sell off. It could be a 10-day rally and markets go up to the 50-day moving average. But we started on Friday building in a short market position in our portfolio because I don't know where the top is. And at some point, the market is going to, I can't tell you this with pretty decent certainty based on statistics. We're going to get a rally, most likely a retest of the October lows, if not maybe make new lows. So as we start this rally, the goal is to use that rally to build a hedge in our portfolio structure, reduce our overall long equity risk, let the market shake itself out as it starts to really come to grips with what the Fed's going to start doing. Now, the goal is for the Fed to be finished with their balance sheet. QE basically would be finished by March. So there won't be any more $30 billion a month going into QE. That'll be gone. Now, the balance sheet will be flat at that point. They're not going to be reducing the balance sheet. They'll just be buying bonds to replace whatever matures. So they'll still be spending money every month, but just buying very short duration treasuries to replace the ones that are rolling off the balance sheet. That's still less liquidity to the markets. Once they finish that, we're going to start seeing rate hikes. So the first quarter point rate hike, that's probably already packed in. Or priced in, sorry, probably even 2 rate hikes are priced in. If the Fed hikes a half point, which there is a small percentage chance they could do that in March if they're very concerned about inflation. That would shock the market. So the reason we're building this hedge in and reducing a little bit risk is that when that March meeting comes around, there is a chance, there's a medium chance. I'm not saying it's an absolute possibility. Nothing is an absolute certainty in investing money. This is why investing money is hard. But there's a chance that the Fed could shock the market and cause a very, kind of a sharp drop. So we want to put a little bit of insurance into the portfolio. If we're wrong and this market runs up to brand new highs and actually breaks out to new highs, we'll take that short position off and, let our equities run. But, when you're managing a portfolio, the goal is to manage risk. And sometimes that requires putting a position on that could lose money, but could help you if something goes wrong in the markets. And again, we don't have answers. There was a great study back in the late 90s, and I think I've discussed this before, is that the study, it studied people that were reading tarot cards, palm readers, psychics, the whole nine yards, meteorologists, anybody, Wall Street analysts, anybody that made a prediction. They went and surveyed all these people, and they got them all to make predictions, and then they followed up on the predictions to see how accurate they were. The most accurate predictor is meteorologists. They are right more often than not, and only 3 days in advance. So, if a meteorologist, and everybody complains about weathermen, right? Because like they said it was going to rain today and it didn't rain. If meteorologists are only right 3 days in advance, how do you possibly think that you can build a portfolio today thinking that inflation is going to do X or deflation is going to do Y 2 years from now? It's just ludicrous. You've got to really manage what the overall portfolio risk is relative to how much volatility you're willing to take. And what do you mean by volatility? Volatility is how much you lose when something doesn't work out the way that you think it was going to.
So Lance, you mentioned the rate hikes and what the Fed's looking to do. Markets are beginning to price some of these things in. What does that mean, though, if we do get softer economic data, and which we do think is likely coming, right? Looking year over year versus 21 to 20, 22 to 21, going to look a little bit different. What's the impact there if they don't do that? Is that good news is bad news, or vice versa? It's funny how we get that information sometimes, and the market takes it way different than you expect.
Well, so first of all, I think the Fed's walking into a huge trap. Now, this is, again, by the way, disclaimer, this is just my opinion. It's not Danny's, it's not Rich's, so it's just my opinion. My opinion is I think the Fed's walking into a huge trap. They're looking at inflation right now going, oh my gosh, we've got to fight this 7% inflation. And magically what the Fed thinks that they can do, and I love the hubris of the Fed, Jerome Powell honestly thinks he can take 7% inflation, bring it down to 2% and stop it right there. And everything will be just fine, right? We'll have 2% inflation. It'll be awesome. The problem with 2% inflation is that's 2% growth. Now, if you're growing an economy at 2%, you're not even growing the economy fast enough to replace new entrants coming into the labor market. You're simply just treading water at that point. So it's great. If you want to have 2% inflation, that's awesome. You're just not growing the economy either. And you can go back to 1980 and there's a very high correlation between interest rates, inflation, and economic growth. If you want stronger economic growth, you need to be able to sustain a higher rate of inflation. So if you want 4% growth, you should be willing to tolerate 4% inflation and 4% interest rates. Unfortunately, we don't have the economic dynamic to sustain 4% inflation and 4% interest rates when you've got 30 trillion in debt, record corporate leverage, record margin debt, and record household debt. So the problem the Fed has gotten themselves into is this debt trap. That's what we call a liquidity trap, where even low rates of inflation and interest don't sustain economic growth. And so all this is going to reverse, and you're going to have disinflationary pressures, as I said earlier, as we move later in the year. The trap the Fed's walking into is they go, we're going to hike rates to crack this inflation problem that we have, and they're going to crack it all right. The problem is when they get to about 1% on their Fed funds rate, they're going to cause a crisis in the market or the economy or a recession. If you don't think that's the case, let me just talk about one of Richard Rosso's favorite economic indicators. He's a huge fan of the Atlanta Fed. So am I. Now, the Atlanta Fed is always wrong when they start out. They're always high. So we wrote about this back in early last year in the second quarter, as we finish up the first quarter of 2021. Second quarter so this is April 1st-ish, the Atlanta Fed comes out with a 16% growth rate for the economy in the second quarter, came in at 8. Then they said, well, the third quarter is going to be about 8%, came in at 2. Then they said that we're going to have a 13% growth rate in the fourth quarter, came in at 6. So they're always high. You know what the Atlanta Fed's first quarter estimate for this year is? Richard, have you seen it yet? Yep. 0.1 for the first quarter of this year.
Yep.
So this
took a nosedive.
Yeah. And look, that's just telling you what the data is already telling you right now. If you take a look across the manufacturing index, as I said, they're all reversing. And DPI is slowing dramatically for households. And this is that liquidity drag that's coming out of the market now. All that liquidity we injected in is gone. So everything's returning back to normal. And that's causing these deflationary pressures already in the economy. And now the Fed wants to start hiking rates. I don't think they get very far before they break something, or they're starting to backpedal saying, we don't need to raise rates as much as we thought we did. You know, I think we're going to pull a 2018 type scenario where we were very close to the neutral rate in October, 20% lower in the market, and magically we're at the neutral rate. So, you know, the Fed stopped doing everything. I think we could very well wind up in the next few months. And that's why I am worried that we're very oversold. We're going to get a rally here. I've got a lot of charts in our newsletter this weekend kind of showing where we think that rally will get us to. But I think at that point, right when about time we get there, we're going to start having other problems economically. And if the Atlanta Fed is even close to being correct, and hopefully they're on the low side this time for a change, we're going to be starting to really talk about a potential recession later this year. And that's not going to be healthy for stocks.
So Lance, could you see, based on that point, not to interrupt you, Danny, because I want to be on that point. So could you still see, one, the Fed, like you said, Stephanie Pomboy is I like her as an economist. She's saying the Fed's probably going to get through one rate hike based on how the economy is decelerating, and that's it. But could you still see a higher sustained level of inflation? So you really go into sort of a stagflation kind of scenario. Do you see that?
Yeah, one and done is I'm actually thinking about writing an article on that, because I've actually got a chart in this weekend's newsletter, and I actually went back in history back to 1970, and I took a run of the Fed funds rate, and then I ran an exponential growth trend line. Don't worry about that. It's just how the growth rate of the Fed funds rate is. But it basically runs along the Fed line, and it suggests where the Fed funds rate should be. And the Fed funds rate should be right now, based on the exponential growth trend, 0.25%. So one and done is most likely what's happening. Now, the Fed generally overhikes too much. And if they go back to their kind of median run, which runs right through kind of the peaks of the interest rate hike, we're about 1% on Fed funds rate. So in other words, they're not going to hike much at all and this is before they create a problem, either economically, financially. The big problem for the Fed now, and I think I have a little different view. A lot of people talk about the Fed put, and they're like, well, if the stocks fall by 20%, they're going to bail out the market. They're not so concerned. My view is they are not so concerned about asset prices. What they are concerned about is a credit crisis. And now those two are often interlinked with each other, but I think focusing on some level of asset prices, saying, okay, at 20%, they're going to come in and bail out the market. I think that's a dangerous view. What you're looking for is where that decline in asset prices starts creating a problem for the banks. Once it begins to create a credit problem for banks, housing, any type of your debt structured market, mortgage-backed securities, the junk bond market, et cetera. We saw them bail out junk bonds back in 2020. When you start getting a credit event, that's where the Fed's going to stop hiking rates. They're going to go back to zero on rates, and you're going to start doing QE again. That's going to be the kind of the mantra going forward. Just my view.
So Lance, you're laying out the kind of the foundation of some headwinds, right?
Right.
We also have geopolitical risk. We also have some political risk here. I mean, what are the odds that, President Biden is going to start knocking on Jerome Powell's door should things get too out of whack, especially being a midterm elections coming up, lots of different things. So, we hear lots of different questions. A lot of these were, hey, should we get out of the market, wait for these to subside? What are the risks with that? And then also, holding cash, we're not opposed to holding cash at different times. how can you put that into a portfolio? Maybe talk a little bit about how cash is not a forever position. And once we get out all the way out, it's so difficult to get back in for many people.
Right. That's the big look. The biggest mistakes we all make are psychological. I make them. Everybody makes. Nobody's perfect trading. You're always going to make a mistake. And we had put on a position a couple of weeks ago in our portfolio. Markets were getting very oversold. We thought we'd get a bounce sooner than we did. We didn't get it. The market, it broke our stop, and we got stopped out of the position to loss. That happens, right? That's, but the important thing is to, and of course we would have just held it, right? It would have been okay. But, that's just the risk management side. And sometimes things work right. Sometimes things don't work as well as we intend. And that's just part of the process over time. The problem that people run into holding cash is, and actually, let me approach this from a different angle. So, I was talking to a gentleman recently, and he's got all his money it's solely into cash right now. I mean, he's 100% cash. And he's like, well, I'm just going to wait until this market gets through crashing, and then I'll buy the market. Now, I can tell you that that's a very bad strategy because of psychology. And Danny will attest to this. Richard will attest to this. So don't take my word for it. But we have prospects come into our office all the time that have been in cash since 2009, right? Now, here it is 12 years later, they're going, well, maybe I should get into the market. Kind of late, right? And I wrote an article about this recently about how holding cash can be as bad as being in a bear market. The problem with being in a bear market, if you have 100% of your money invested in stocks, it's you can lose half your portfolio. Well, if you've been all in cash for the last 12 years, you've missed a 400% rally in the market. So what was worse for your financial outcome, being all in cash for the last decade or be it participating in a crash? They're both equally bad is my point. Both of those are bad. So the problem with being in cash is the psychology of it. What's going to happen is this market is coming down. So people are going, well, I'm just going to be in cash. I'm going to wait until this market bottoms. And then the market's going to fall 30%. And they're going, see, I told you I was right. And they're going to be very confident in their position. Market's going to fall another, this is all theory, right? I'm not saying we're going to fall 30% or 50% or anything else. We're talking about psychology. And the reason I know this is because I saw this happen in 2008. Market's down 40%. See, told you, I was just right. And as soon as this market bottoms, I'm going to buy. So let me tell you a real story about 2008. So in 2008, we sold out of all of our portfolios of equities. We were down about 8% from the peak, closed out all of our equity positions. We had broken, there was a head and shoulder. I've got this actual chart in the newsletter this weekend, but there was a head and shoulders pattern that was built in market. It broke. We retested the bottom of that neckline, and that was all she wrote for the bear market in 2008. And we were completely in equity. And I learned a valuable lesson at that point about putting clients into cash. So in 2009, in February of 2009, I wrote an article, 12 reasons why you should be buying the market right now. We lost about $100 million worth of client assets because they were convinced the Dow Jones and the S&P was going to zero. Now we were at 666 on the S&P in 2009, and people were convinced the bear market was not over and we were going to go down to zero. I mean, this was the end of the world, right? And psychology, even though they were right all the way down, could not fathom how to get back into the market and start putting risk on at the worst time. There's an age-old axiom in the market that says, you want to buy when there's blood in the streets. That is the hardest thing for people to do because you've got to go against every emotional gut feeling you've got, and you've got to start buying assets convicted to the idea that, yeah, they may go lower, but now you're going to buy them and hold them and you're going to work through this process. It's a very, very tough thing to do. And being all in cash, the biggest problem of being in cash is getting out of cash and back in the markets. Oh, and that was a very long-winded way to explain that.
Oh, but that's a great answer, Lance. And, the problem we see, talking about like what we see on our end of the table is that those people who are calling now saying, hey, let's get back in the market. Well, guess what? They sold out in 2009. They locked in those losses, and then they've never seen those come back. So it's a double-edged sword in that aspect, is that you lock these in and you don't give yourself the opportunity to get back. Now we're getting in at the tail end potentially of one of the longer bull cycles we've seen.
Real quick, I just want to clarify one point here. When we talk about going to cash, and to your point, right, we'll go to cash, but A, we're not going to be 100% in cash, and B, we're going to get back in. Cash for us is not a long-term position. It is something that is there's a couple of ways to hedge your portfolio. I can buy bonds, which will hedge your portfolio against volatility risk. And if markets are declining, interest rates will go down and bond prices will go up. So bonds are a good hedge. But they have risk, right? Interest rates could go up temporarily while the markets are going down. I'm losing money everywhere, right? You just won't lose as much in bonds. But there is
what we've seen over this last month, which hurt even more.
Correct. So that hedge still has risk. I can short the market, and that'll certainly hedge my portfolio, but that hedge can lose money if the market rallies. Cash has no risk. I can be in cash temporarily until I figure out what the market's going to do, and I've got no volatility risk with cash. So there's different ways to hedge a portfolio, and cash is a very effective one because it has no risk. I can remove risk from the portfolio by being in some part of it in cash. Again, being 100% in cash is never ideal. The lowest we will go exposure wise in our portfolios is down to just 25% of our target. So if our 60-40 allocation is 60% stocks at target weight, we'll never go below 12.5% exposure because, again, once the market begins to turn, I've got some exposure to start building off of. Now I can short against that 12.5% exposure and take it to effectively zero in the portfolio, which we'll do that. And that's why we're building a hedge now. But, we can reduce exposure multiple ways, but being 100% cash is the one thing you don't want to do because you can't get back in the markets. And despite, by the way, how bad whatever market's going on, there's always opportunities to make money somewhere. If money's leaving the equity market, it's going somewhere else. Where's it going? Probably into bonds.
Yeah. So that's a good point. So piggybacking off of that, fixed income, how do you invest in that? How do you onboard if you are in cash, moving in? We have a little bit different strategy, at RIA, and going back from a disclaimer, we are RIA advisors. These are not any, recommendations. We're just talking broad, big picture here.
Right.
So how do you look at, fixed income? It's a difficult scenario, and we've had to think outside the box in general, just to, try to look for something that's going to give us a little bit of a hedge, but also find some ways to use it to, our advantage.
Right. I just saw a question pop up a second ago. It says, do you like rising rate funds right here? When we talk about how to position portfolios and these type of things, you've got to start looking, from what was working to what will work. And this is one of the biggest challenges that investors have. And I had a really good question the other day. It's like, why don't I just put everything into tips? Because tips returned 10.5% last year. Yeah, that's what worked last year. What was going on last year? The Fed was buying tips, which was driving up the price. Tips don't return 10.5%. That's total return. That's the dividend yield plus the capital appreciation. The dividend yield on tips right now, short tips, are about 2%. So if I go put my money into short tips, or if I even buy tips, they're about 4% right now because inflation is starting, we're already starting to see these inflationary processes starting to pull back on disinflation. So that yield is going to fall in tips. So again, you can't look at what was, you have to start looking at where you're headed to. Interest rates, as an example, are extremely overbought here. And once the Fed starts hiking rates, then look, interest rates rise heading into Fed rate hikes. Once the Fed starts hiking rates, if you don't believe me, go look at 2018. When the Fed was hiking rates and starting to taper their balance sheet, interest rates fell very sharply. So if I was a buyer of something right now, I'd be betting on lower rates heading into the rest of this year, not higher rates, because of the disinflationary pressures we're going to have.
So, lots of questions about different opportunities. What about like preferreds? I know we've invested in preferreds, reduced exposure recently. What are your overall thoughts? Because we have to be careful because there's a lot more volatility in that area.
Yeah, we're actually going to be reducing preferreds a whole lot more because preferreds are very sensitive to the yield curve. And the yield curve is starting to drop rather rapidly. And if the Fed starts hiking rates even more, that's going to push the yield curve into negative territory. In other words, we'll have an inverted yield curve. So I don't want to be long preferreds in that environment. So preferreds are extremely oversold here. So we think that they're going to bounce. They bounced a little bit yesterday. We started selling some yesterday. If they bounce some more over the next, week or so, we'll probably reduce the big bulk of that position. We actually have preferreds kind of in our fixed income portfolio to help increase the yield on the fixed income side, but they're effectively an equity position because preferreds are stocks. But they're very sensitive to the yield curve. So, if we get into a disinflationary environment with a inverted yield curve, preferreds are not going to perform well. So, we want to start reducing that risk and start building, longer end duration, bringing our longer end duration of our bonds, 10-year, 20-year bonds up in terms of sizing, because they will benefit from an inversion of the yield curve.
So I'm going to throw a couple things at you, and you can figure out how to answer this one, Lance. US dollar, oil,
yep, and
international stocks. How do you invest? Because they are tied together. We need to be cognizant of how they all work together, correct?
Yeah. So the dollar is breaking out. There is a real possibility that we're about to see a very sharp surge in the dollar. And this is why we sold off more of our energy stocks yesterday. And this is also kind of going into this whole idea of, positioning going forward. US dollar is surging. That's not good for commodity stocks or inflation. So this will be part and parcel of that kind of that disinflationary process we're going through. And the one thing you want to watch real careful here is the dollar. That's more importantly than anything else. One of the things I've been hearing a lot lately is, I want to buy international and emerging market stocks because they're cheaper relative to the US. And that's true. They are cheap relative to the US. These countries are not cheap relative to themselves. And they're just as expensive as pretty much we are. And you got to remember that emerging markets in particular are very dependent upon exporting goods and services to the United States. We're their major customer. So we've said this many times in the past, is that if we get a cold, i.e. a economic slowdown or recession, they're going to get the flu because they're so dependent on what we're doing. So, there's a lot of impacts here that I'd be careful of. There are times that we want to own emerging markets and international. There are times that we don't. But holding international emerging market stocks over the last decade have been a boat anchor on portfolios. So if your portfolio strategy over the last decade has been, hey, let's just be diversified, I'm going to own large cap, mid cap, small cap, international, emerging markets, just a whole basket of stuff, you've underperformed the S&P by a very large degree because those assets have underperformed domestic stocks. Now, is that going to change in the future? Very possible. But right now, the dynamics of those countries outperforming relative to the US are not in their favor if we move into a disinflationary or a deflationary environment.
Lance,
but watch the real quick, Richard. But watch the dollar. The dollar is the big problem right now. Go ahead, Rich. Sorry.
So to your point, which is really counterintuitive to how people are thinking right now, because everybody's got the inflation goggles on.
Right.
But if you look at the indicators, like you're saying, and I said it on the radio show yesterday, you've probably already peaked in inflation and you're heading on to that disinflation, deflation cycle, because the market is already looking ahead at this. And I think to your point of why the dollar goes up, as we live in the United States, we get this, we don't look at ourselves relative to everybody else, right? We're still the cleanest dirty shirt, right? So if the whole world is slowing down, which it looks like because rate hikes overseas, money comes into our markets, right? They buy our treasuries and our dollars. Because even though we feel like things are not going well, I read a great Pew Research Center study this morning talking about how most Americans are not confident in the economy. But we're still probably better off than a lot of other countries overall, don't you think? So that's why people buy our treasuries. When things go south, our treasuries that's where the money tends to go, right? When there's risk off.
Well, another reason the dollar is surging right now, and to your point, you're absolutely right. But first of all, just let me take one step back and explain something about how currency works, because this is a very important point to this whole conversation. If you don't know how currency works, then you kind of miss an important driver. The US dollar never leaves the shores of the United States. So if I'm buying something from China, as an example, so let's say that I buy a new laptop computer from China and they ship me the product. So I've got the product and I pay them in US dollars. China doesn't get US dollars. The dollars don't leave the US and go into dollars into China unless China chooses to take them in as dollars. This is a China choice. China has a decision to make because they want to keep their currency relatively pegged to the United States, because if their currency gets too expensive or too cheap, it has economic impacts of what's happening on that transactional basis between the two countries. So China, and we talk a lot about, well, China owns, $1 trillion worth of our treasuries. Japan owns, a gazillion dollars worth of our treasuries. Why do they? Nobody ever asked the question, why do they own all these treasuries? The reason is that as they have this currency, this need to keep their currency relatively pegged to the United States for economic trade, they either have to take dollars in. If they take dollars into their current, if they take the dollars and move it into their currency, that's going to make their currency more expensive relative to the US. If they don't want to do that, if they want to keep it stabilized, they buy treasuries. So the dollar actually never goes to China. They use it to buy treasuries to sanitize those transactions, and that keeps the currencies relatively pegged on a transactional basis. So that's why they own all these treasuries. It's not economic warfare. It's economic stability is what they're trying to maintain on a currency basis. So right now, what's happening geopolitically, right? My son called me yesterday from Germany. Military troops going up and down the streets right now. They're even sending out flyers that says, if things go bad in the Ukraine, we're going to hand all of our citizens guns, just to be, aware of what's going on. It's a very concerning aspect. Germany's sitting right on the border of Russia and everybody else right over there. I mean, they're right in the middle of it. So if I've got currency, right? So I'm in the German mark, or I'm in Ukrainian dollars, or whatever it is, and I'm worried about an outbreak of geopolitical tension or potentially warfare, what am I going to do with my money? Particularly if I'm a major pension, hedge fund, investor, whatever, I'm going to go buy US treasuries. Now, this is the important point to Richard. As Richard says, they can buy treasuries or dollars. They don't buy dollars, they buy treasuries. The treasuries when they buy the treasuries, that converts the euro, say it's a euro, right? They're going to buy treasuries with the euro dollar. When they buy the treasury, that converts it into US dollars. So two things happen when you get an inflow, and this is why the dollar's shooting up. All this stress that's happening in the Ukraine right now, people are sending money into the US dollar, they're buying treasuries. So if money flows, so if global economies get weaker than the US, and to Richard's exact point, we're the cleanest shirt in the dirty laundry. We also have a higher yield than a lot of other people have in the world right now. And if you're storing currency, if I've got a few $1 billion, what do I want to keep my dollars in? Do I want to keep it in the Chinese yuan? Do I want to keep it in the Russian ruble? Do I want to keep it into the French franc? Where's the most stable country in the world? You may not like our country, what's going on right now, but we're still the most stable economy in the entire world. Money comes here. So you get geopolitical stress, you get economic slowdown, money's going to flow into the US Treasury. That's going to drive yields lower, prices up, and the dollar's going to rally. So this is the dynamic that we're setting up. And I think this is the one thing people are missing right now with this Ukraine situation is that, wow, what happens there geopolitically, how we handle it, sanctions, war, whatever, I don't really care about that. What is going to happen with the dollar and the treasury, and money is already flowing into that. So watch that very closely.
Essentially, you're saying that turmoil will cause people to go seek out the cleanest dirty shirt.
Bingo.
Yeah.
Yeah. You do want your money back at some point, right?
Correct. Well, you're not getting paid much, but you'll be getting paid much less at that point when there's so much demand.
Right. Or if your money's in Russian bonds, Russia has the ability to come and say, you know what, I'm just going to keep that money. China too, Malaysia, a million other countries. The problem is also regimes and structures. Do you really want to store your money in a communist country? There's too much geopolitical, too much governmental risk at that point. So. Yeah. Lots of good points there, Lance. So Rich, kind of segueing here just a tad bit. We've talked about some political headwinds, some of the other things, geopolitical tensions, not to mention the Fed raising rates, and obviously a lot of volatility. What is the likelihood that we see a new renewed push for higher taxes?
Oh, if you don't think taxes are going higher, and I don't care which administration you're in, you're sadly mistaken. So you have to really look at, especially if you're going to be in distribution mode, right? In retirement, how that's going to affect you. Remember, Danny, and Lance probably remembers this even better, but Danny, you're on the tail end of this, that in the 90s, we talked about always that you were going to fall into the lowest tax bracket in retirement. So we tend to keep those fairy tales going. You know, these fairy tales last longer than like some of the ones that have been around for generations and centuries. And what we find is with Social Security taxation and IRMA charges on Medicare, as social safety nets get pressed, that it's rare for individuals to fall into the lowest tax bracket. So, and Lance brought it up with the debt and the deficits. If we don't directly raise your taxes on the front end, then we'll take them out of your back pocket through Social Security and or Medicare premiums. And we've adjusted inflation appropriately in our plans to reflect that, Danny. So we need to realize that we're not protected from higher taxes regardless of administrations. At the end of 2025, the Tax Cuts and Jobs Act, right, that sunsets. The larger 22 and 24% tax brackets get squeezed. So we're trying to plan clients to have tax efficient retirement income distributions as well.
Yeah. Look, you've got right now about 115% of all tax revenue that comes. So every dollar you pay in taxes, 100% of whatever you pay in taxes goes to cover Social Security, Medicare, Medicaid, prescription drug benefits, and interest on the debt. That's all it covers. That's the mandatory spending. Everything else we spend government-wise is more debt. So taxes are going to go up. And, you know, and to your point, I do remember that in the 90s, is like, when you retire, your tax bracket will go down. That's not my goal. My goal is to be in the highest possible tax bracket when I retire, right? I mean, I want to have made so much money that, you know, I've just got all this money sitting there and I'm going to be in the highest possible tax bracket.
It may not even be your goal, but you're going to wind up there just based on taxation on Social Security. Yeah. And, you know, this is a reality that we plan for overall. And
well, I think that goal is great, Rich. But at the same token, though, we want to find ways that we can tax efficiently manage funds. And you know, if you're still in that accumulation mode, putting funds in proper places to give yourself more flexibility. I mean, how many times do you see somebody who's done exactly what they were told, put all these funds in the pre-tax accounts, built a 401k, and then they don't have any flexibility at the end of the day, and every dollar they pull out is taxed at whatever Uncle Sam says.
We tell everybody, listen, if you are just planning to save taxes now, you know, retirement comes sooner than you think. It's like having a farm with one magical animal that supplies everything. The only person who believes that is Homer Simpson. The pig does what? It provides pork chops and bacon and what? There's one magical animal, Lisa, that does all that. If I'm going to retire, I want multiple animals on my farm to prosper. And we help people understand the importance of diversification of accounts. Now, we'll tell you, this is a good time as markets are down to do Roth conversion, right? Because you're moving money from IRAs where maybe you're moving depressed assets into Roth, which means you're going to pay less on taxes on those assets, let them appreciate back in the Roth. So that's where planning helps to work with the portfolio management and risk management overall.
Hey, Danny, I know we're getting a lot of questions here. How about we spend a few minutes just kind of rapid fire? Let's do some rapid fire yes or no's. Yeah.
All right, so we'll just go to the most recent one we have. I still have, you know, pages and pages of questions here as well. So, and we're going to get to these. I think what we're trying to do is kind of wrap these up and talk about them kind of in broad strokes here. But so when do you think rates are going to actually move, Lance, and overall impact? How many rate hikes? I'm going to put you on the spot here.
Yeah. Well, look, like I said before, probably one and done would be the most likely case, and that'd be kind of reality of where we are. I think they're going to try to do 4 this year. I don't know if they even get there to 4 before something happens, but you know, if they get to 4, I don't really see them going. You know, in other words, we get to 1% on Fed funds rate. That's probably going to be about as far as we go. At that point, if they're at 1 on the Fed funds rate, to answer a couple other questions I saw come in, we will have an inverted yield curve, and the interest rate on the 10-year Treasury will probably be approaching 1%.
Well, and let's put this in context too. If they are going to continue to raise rates, that's not necessarily a bad thing if the economy can support that.
Right. If you had organic economic growth and you had the ability to produce and manufacture and, you know, and people were working and all this other stuff, yeah, you could support higher rates. The problem is look, you take a look at the employment rate right now, we're 4.2%, right? We've got full employment. How do you have full employment when you've got a 62% participation rate? And that does, and people go, well, that's because of all the retirees. And that doesn't really play out to that fact, because you have a very low participation rate in the 25 to 54-year-old bracket. So, we have problems economically on the employment front and economic growth front that and the reason that we continue to have these disinflationary pressures is ultimately because of the debt. We not just government debt, corporate debt. We've got a tremendous amount of companies that are dependent on debt just to stay alive. We call those zombies. And then you've got record household debt, you've got record credit card debt, you've got record margin debt. I mean, you take a look at record housing debt. So wherever you look, this entire economy is now based on debt. That wasn't the case back in the 1960s, way before Erica was even thought about. But back in the 1960s, 70s, the average debt to household net worth was about 60% debt to household income. Now, they basically had a mortgage. That's all they had. My dad never had a credit card. I'll guarantee you Richard's dad never had a credit card. They paid cash for everything. That was the mantra. So there was a lot of excess capacity. People were working, we were producing, we were manufacturing stuff. And that's what allowed, and I can make an argument. I think Paul Volcker made a terrible mistake in the 70s by trying to crack inflation and financialize and the financialization of the economy, because we were growing at 8 and 9%. Savings rates in households were running 8 and 9%. Yes, interest rates and inflation were going up, but so was the rate of growth in the economy. So, you had this very strong, vibrant economic economy. And yeah, you had the oil embargo, but that was a temporary event. And had you just allowed the economy to continue to function, it would have been able to sustain higher levels of economic growth and inflation over time. When we started the financialization of the economy, ever since that point, right? I mean, ever since Volcker, we've had a consistent decline in economic growth, economic inflation, and surging increases level of debt. Now households have about 150% of debt to net worth. So, they just simply are so indebted that every dollar of income they have coming in is going to service debt, and you can't create economic growth that way.
Yeah, absolutely. So good points there. So big picture here, we talked a little bit about oil. What do you view on that? Especially with the geopolitical tension, is that going to continue to be a play? And with strategic oil reserves, some barrels being released from there, I mean, what does that look like, big picture?
Watch the dollar. That's all you need to know. Look, we started taking profits out of our energy stocks yesterday. Yes, oil could go to $100 a barrel with what's going on in Ukraine. But again, that's a good thing, bad thing, right? Short term, you get a pop in oil prices, awesome for energy stocks, et cetera. But that's also bad for the economy. If I'm spending $5 at the pump, I've got $5 less to spend somewhere else. And that is that diversion of money from economic activity. Take a look at retail sales back in December. That's a good example of this. People weren't buying more stuff, even though we had a big surge in retail sales. They weren't buying more stuff. They were buying the same amount of stuff, just paying a lot more for it. And we measure retail sales in dollars, not in volume. So, the higher oil prices go, the more impact it has to the overall economy in a negative way. And oil ultimately is traded in dollars all around the world. So if the dollar is going up, that means everybody overseas is having to pay even more for the gasoline because we trade everything else in dollars. So they've got to convert from the euro to the dollar to buy oil. It's not good for their economy either. So, this is why oil prices in particular are big boom bust indicators, because, they have big runs and then everything falls apart. And then they have a big run, it falls apart again. And, commodities as a function have been in a negative downtrend now since 2008. And that coincides with what's happening with economic growth. So yeah, we're getting a nice little bump in commodity prices here that will increase inflationary pressures to the point that we start getting disinflation in the economy. And when that occurs later this year, commodity prices start to come down.
Well, speaking about commodity, you're talking about more energy particular. What about
no,
precious metals?
No, commodities, precious metals, those are all tied to the dollar and inflation. Real rate. So when it comes to precious metals, it's real rates. It's inflation adjusted rates. That's what drives precious metals.
Great. So, Rich, how do annuities or life insurance fit into an overall retirement plan? Obviously we see a lot of guys out there selling just those. How should somebody look at that?
Yeah. First, I'm going to say, Lance, you're right, because people are skating to where the puck is, not where it's going. So I remember something you said last year. Never forget it. Or even the year before, like December, you said, I wish I could put 40% of the clients' money into energy stocks.
Yeah, it was December of last year.
Yeah, when they got totally slammed.
Yeah.
Right now, everybody wants to go into energy stocks, and it's the best performing sector, right? So everybody's chasing that when the market is going to start looking ahead. Not that, like, I agree with you. I think energy prices are going to stay higher this year, but you're going to see a lot of, again, hot money go into this where you may want to be very counterintuitive. Without rules, people are going to get really messed up this year. I can't say that any better. Now, when it comes to looking at insurance and annuities, you got to remember the one thing we all battle with is longevity risk. We're going to live longer, depending on your age. We see massive improvements in healthcare and how people live. Well, guess what? You could outlive your money. So if you plan properly, using annuities to create your pension on your own is important. But I guess life insurance, one, is always the need for life insurance. But I think, Lance, you're always a good spokesperson for this, because people think, and again, everybody's for term insurance. And I think term insurance is a cycle by when I'm early in my career and I want as much pure insurance as possible. But when I get in my 40s and 50s and I still maybe want a legacy, I should possibly look, and my cash flows are stable, I want to look to permanent insurance, because not only can that provide protection for my family or an estate issue or whatever it might be, but I can withdraw that money over time. It can grow and I can withdraw it as a policy loan. And guess what? Those kinds of products do not engage taxes on Social Security, IRMA charges when you borrow from them. And I think that's an important way to save for retirement. People might hear these commercials on the radio. Do what the most, the richest men in America have done, right? J.C. Penney, Walt Disney, and you don't know what they're talking about. They're talking about life insurance as part of your process. But there's a time to graduate, I think, from term.
I know, absolutely agree with you. If I knew what I knew now, I would have been buying whole life insurance when I was 20.
Me too.
Yeah.
You know what? I say that all the time. If I knew what I knew now, I would have a Roth 401k, not even a traditional, and life insurance. I have one person I know that is going to get over $100,000 in retirement income from policy loans and Roth, completely tax-free, which means all his Social Security is in tax. So who's the stupid one?
Yeah, no, I agree. I mean, term life is great. Like you said, if you're trying to solve a short-term problem, term life is great. You don't have a
lot of cash.
It's great. But the problem is that you're going to spend premium money over the course of 10, 20, 30 years, add that up, because that all goes to zero when that policy matures. So, the thing about whole life is, to Richard's point, is you put money into it and it grows, and it actually has a growth rate to it. It's like a high yield savings account. It grows 3-4% a year, every year compounded, and all that money is tax-free when you withdraw it out. So, like I said, and you can borrow against it. I use my whole life insurance policy to make other investments that have a much higher yield. So, I do a lot of my real estate investing using policy loans from my whole life insurance. And then when the real estate's done, I repay the loan on the bank. I keep the spread, and it works fantastic, and it's all tax-free. So, like I said, we should do a whole Candid Coffee just on the benefits of whole life insurance, but it is such a great way to shelter money and build wealth that I wish I would have known about it in my 20s.
Yeah, no, that's a good point.
Because I wouldn't be doing this now.
Well, and it would be not just whole life per se, but permanent life. And so keep in mind, risk management, you're going to need that term for a period of time. The other way is to have a very defined strategy on how you actually would invest in that. So you want a financial plan, you'd want to back into these numbers. I think that's the most important aspect when we talk about any of those types of insurance products, so to speak. Make sure that you're not sold one, and make sure it's not by somebody that's all they do. Not to say that that's bad, but you want to take that holistic view. I think is going to give you a much better.
And by the way, all permanent life is not the same.
Correct.
You got to make sure you buy the right policy.
Yep. You need to make sure you understand what the loans, how those look, what the interest they credit, things of that nature. So Lance, wrapping up, we've been at a full hour. We really appreciate everybody joining us today. Any final points or topics? I know we've got a ton of questions.
Yeah. So first of all, if you got a question and we didn't get to it today, go to the website, realinvestmentadvice.com, click on the ask a question link, send us an email. We'll answer it for you. We'll do this again here soon as we kind of get through this period we're in. We'll have another Candid Coffee to, kind of talk about whatever happens next. But again, look, this is just going to be a very challenging period. The goal here now is not to make mistakes. Don't make panic-driven decisions because markets are down. Be careful of getting confirmation bias. This is one of the biggest problems and challenges I see right now is people are there. I was listening to, Jeremy Grantham the other day. He says, we're going to have, the world's coming to an end. He may be right. But he's been very bearish for a very long time. John Hussman is too. Nothing wrong with that. Nothing wrong with those views. Very smart guys. On the other side of that ledger, we've got Jim Cramer and we've got Jim Paulson. This was the bottom. You got to buy it. And they're all bullish. Be careful getting trapped in one of those camps, right? Analyze both views. If you have a bearish bias, listen to some of the bullish views and don't just dismiss them. Analyze the bullish view and say, why are they bullish? Does it make sense? And does it counteract what I'm thinking personally? Is my view possibly flawed? By only looking at something that confirms your own bias, you may be walking yourself right into a trap because, again, one side's going to be wrong. I don't know who it is, but one side's going to be wrong one way or the other. And so if you happen to wind up on the wrong side of the ledger because all you're looking at is that information, that's where your risk is. I'm going to tell you right now, and this is why we talk about this a lot, our logo is an eagle, because we can't afford for our clients to be all bullish or all bearish. That's how you wind up making huge mistakes on your money. Being an eagle, we just kind of look down on this and say, what's the landscape? What's the economics of this? What makes sense? And then allocating our portfolio accordingly. And actually, if you look at our portfolio, we're a little bullish and a little bearish. So, and you can be both. You don't have to be just one way or the other. So really be careful about getting confirmation bias. And if you're only reading one type of article, you're getting confirmation bias. So recognize that and start reading something else.
Yeah, very, very good points, Lance. Thank you for joining us today. Hey, so lots of questions. Please go fill out the survey at the end. We're also going to be giving away a couple of these Candid Coffee mugs. So if you fill out the survey, you have any questions, please let us know. Also, if you'd like somebody from RIA Advisors to give you a contact, just give you a call. Maybe you want to learn a little bit more about what we do, how we do it. We'd love to help you. realinvestmentadvice.com, go ask a question, or alternatively, go answer that survey at the end of this. Thank you guys for joining us. Everybody have a great Saturday, and we'll see y'all next week.
See ya. Bye.